Hi, thank you very much. Good afternoon to everyone. Today, in this currency segment, we'll discuss our views on two currencies. So first, we'll look at the US dollar. Now, the US dollar was one of the top performing currencies in 2022. But as I mentioned, we'll look at three reasons to remain cautious on the US dollar moving ahead into 2023. Then we'll look at cryptocurrencies. Now, cryptocurrencies were one of the worst performers in 2022. And today, we will reiterate why we think investors should stay far, and very far away from cryptocurrencies. Let's start off with the US dollar. Now, the 2022 was a great year for the US dollar. It was a standout year. Its 8% climb in 2022 was one of its strongest in recent history. It's been surpassed by previously in 2014 and 2015, and before that in 2005. So this was driven mainly by two things. First, widening rate and yield differentials, and second, safe haven flows, both of which I'll talk about later. So one thing to note, if we look at the USD's performance through the DXY index, the US dollar index, we can see that historical up cycles for the US dollar have lasted about 6 to 7 years on average. Currently, we are at 11 years and counting. So, because of this extended period of USD appreciation over the past 11 years or so, the USD now looks very overvalued. So what we did is we looked at the US dollar's real effective exchange rate, or REER, and this measures a currency against a basket of other currencies adjusted for inflation. So what we find is that this REER currently sits at very extreme levels. These levels have only been reached twice in history. First, in 1972, when the US was still on the gold standard. Second, in the 1980s, and that's where the Fed did an unprecedented rate hike to 20%. And we think that the current economic backdrop is far from reaching such extremes at the moment. For confirmation, we look at another metric. We look at the purchasing power parity, or PPP, of the US dollar. So this compares the purchasing power of different currencies benchmarked to a specific basket of goods. And what we find is that this PPP metric suggests that the US dollar is overvalued against all but one currency, with a whopping 30%, for instance, against the Japanese yen. And hence, we believe that this overvaluation of the US dollar through RER, through PPP, sets up for a potential reversal of US dollar strength. And we think that currently, with heavy long positioning in the US dollar, this hints that the reversal could come even sooner than you might expect. So across 2022, investors have bet on a strong greenback. They have bought the US dollar, gone into the US dollar. And long positioning, as a percentage of total positioning, remains stretched at the moment, as you can see on the chart. And what this means is that conditions are ripe for a correction. Once we see the emergence of negative catalysts that could drive traders to cut back on their long positioning. And one important negative catalyst that could drive this reversal is narrowing rate and yield differentials. So historically speaking, rising rates have led to increasing real yield differentials. And then rising real yield differentials have in turn led to more people buying the US dollar because of the better yields on offer. So it's unsurprising that if we look at across history, we see a strong positive correlation between real yield differentials as well as US dollar strength. Correlation plus 0.82. And 2022 itself was not an exception. So what we saw in 2022 was the Fed hiking rates more aggressively than other DM central banks. And this has in turn led to real government bond yields in the US rising ahead of many of its DM counterparts. And this, again, has in turn led to the USD appreciating against many of its peers through the DXY index. But looking ahead, what do we think? So looking ahead, we think that rates and real yield differentials are set to narrow, which should lead to this key USD driver of 2022 fading away and reversing in 2023. So on one hand, we expect the Fed to pause its rate hike cycle in early this year at about 5%, 5.25%. But on the other hand, what we see is that other DM central banks have a lot of room to catch up. And that's in terms of rate hikes. And this is because inflation readings, as you can see from the chart, are much higher in the rest of DMs as compared to the US. So two markets we want to highlight here are UK and Europe. So sterling, pound, and euro. And first, we include them because they have a large composition in the DXY index of over 60%. And we note that these two markets are actually facing very strong inflationary pressures right now in the US, currently facing double-digit inflation compared to the US 5-6%. But despite this, their central banks, ECB in Europe, BOE in UK, have not hiked rates as early, have not hiked rates as aggressively as the US so far. And we think that a lot of DMs, including especially UK and Europe, have a lot of room to out-hawk the Fed in 2023. So let's move on to the third reason. So we saw that in 2022, a key driver for the US dollar was safe haven flows. But we believe that as we head into the new year, the US dollar's safe haven appeal may falter in 2023. So first, we acknowledge the possibility of a mild recession. So this could lead to an easing of safe haven flows. So previously, in a few slides ago, we saw that positioning in the US dollar was already very long. And this was because a lot of traders moved in the US dollar in anticipation of a recession already. But initial signs in the US are pointing to something mild. So if we look at household liquid assets and debt service ratio as a percentage of disposable income, you can see that household balance sheets are actually still looking quite robust for now. And we think that this suggests with a mild inflation coming up in the US, investors might already be pricing in somewhat of a recession. We might not get that much of an increase in safe haven flows from today compared to what people are already expecting. But even in a more severe recession, we think there's a risk that other safe haven currencies may emerge and take the place of the US as the safe haven FX of choice. So for example, we have listed the Japanese yen and the Swiss franc over here, both of which are traditional safe haven currencies. So we want to highlight the Japanese yen in particular, given its poor performance last year. So last year, the Japanese yen performed very poorly. And this was due to widening real yield differentials. As you can see from the chart, US yields have climbed up, Japanese yields have remained relatively flat. This was because the BOJ engaged in its ultra-loose monetary policies, kept this ultra-loose monetary policy intact. And in contrast, the Fed turned more hawkish throughout 2022. But in December last year, what we saw was the BOJ's surprise widening of its yield curve control band. And we think that this is a sign that they are warming up to further tightenings in 2023. So this should in turn help to push up Japanese yields, which then makes the Japanese yen probably more attractive as a safe haven currency in 2023 compared to the US dollar. So with all that being said, I think we can see that there are many factors that affect the demand of safe haven flows. So it includes the severity of incoming recession affecting broader safe haven flows. It includes idiosyncratic factors affecting which safe haven currency investors will pick. And with these many variables, it is unsurprising that the US dollar has displayed mixed performances during previous recessions. So what we did is we narrowed down the 8 previous recessions in the US defined by the National Bureau of Economic Research, NBER, and we found that the USD actually depreciated in 4 of these 8 recessions. And this is honestly not a very convincing record if you're looking for a foolproof safe haven. So if we look at market volatility instead of economic volatility, we get the same result. So for this, we use the VIX index, which is a gauge of US market volatility. So normally, we would expect a safe haven to have a positive correlation with the VIX index. This is because if volatility goes up, then theoretically, a safe haven demand should also go up. But we don't see it in this case. We can see it oscillates between positive, negative, and if we just do a simple average of the correlation throughout the years, we get a very tiny plus 0.05. Furthermore, what else we did? We isolated periods of high volatility. So we looked at months when the VIX peaked above 35. So why we chose 35? This is the top 5 percentile of the VIX index. So the most volatile periods. And in 7 of these instances, the correlation was actually negative in 3, about half of these instances. And this again suggests an inconsistent performance of the US dollar even during periods of heightened market volatility. So moving beyond the shorter term, medium term safe haven flows, I think I want to end off this point with one last point on long-term safe haven flows. We think we are seeing a long-term trend of de-dollarization playing out over the years. And this is observed through the decreasing share, the gradually decreasing share of the US dollar over time in international foreign reserves. And we think that this trend of de-dollarization could accelerate in the coming years due to the US's decision to weaponize the dollar against its rivals. And we think that this could dim the allure of the US dollar in the long term, especially for countries with a more tenuous relationship with the US. So let me summarize what I've said about the US dollar. So we expect a reversal of USD strength in 2023 due to three main reasons, namely stretched valuations, narrowing real rates and real yield differentials, and inconsistency as a safe haven. So with the USD expected to weaken in 2023, we recommend that investors evaluate their portfolios, your portfolios, for any US dollar exposure. So one way to start off is to look at your unit trust investments, which we are classifying into two types. So first, if you have a unit trust with exposure to US assets, for example, a US equity fund, we recommend choosing a hedged share class for this fund to neutralize out this USD exposure. And second, we recommend avoiding US dollar hedged share classes in general and look at other currencies instead. With that, let me quickly move on to cryptocurrencies. We'll look at it using a similar framework and we'll explain why we are negative on cryptocurrencies in 2023 and beyond. So first, like the US dollar, we look at valuations first. So we think that cryptos are supremely overvalued. In fact, we think that many cryptos have little, no intrinsic value to begin with, meaning that their fair price should theoretically be zero. So how we look at stocks in the first place is we usually look at them based on projected future earnings. So after all, stock prices, as you can see from the chart, have shown a very, very strong long-term correlation with earnings, plus 0.96. And this is based off 150 years of S&P 500 data. And this is why PE ratio is actually one of the most commonly used metrics in finance because of the strong importance of earnings in determining price. But what about crypto? If we look at crypto, a large majority of crypto have no earnings, no cash flows to speak of. I'll say most crypto is essentially an arbitrary coin or concept conjured up from nothing. So again, no earnings, no cash flows, nada. And that means no matter what PE ratio, price to earnings ratio we apply to it, if your projected earnings of this crypto is zero, then your fair price is essentially zero. So another way to look at an asset is to look at underlying assets. So some of you might look at price to book ratio. But again, many cryptos are actually magically created out of thin air, very little underlying assets backing them. So we look specifically at stable coins. So these stable coins theoretically should be 100% backed by underlying assets. But they have seen many scandals over the years over their lack of reserves. So this is USD Tether. This is one of the biggest stablecoins right now, even now. And it only has 82% of its assets backed by cash and cash equivalents, as you can see from the chart. Remaining 18% is in less liquid and potentially more risky products. There's very little transparency on this breakdown of 82% cash and cash equivalents, even less transparency on the 18% risky side. And if we get periods of market stress like we saw last year, we cannot rule out the possibility of insufficient reserves, bank run, especially if these reserves turn out to be lower quality than expected. So what this means for you as an investor is that most cryptos not only have no earnings or cash flows behind them, but they also not backed by a sufficient amount of underlying assets. Then the question is, what are you investing in for crypto? I think we've said it for multiple years now. We said it at last year's Expo, and we'll say it again. Crypto is essentially a greater fool asset class. It's no intrinsic value, and what it's reliant on is people generating hype, hoping that they can sell their crypto off to a greater fool. So many financial professionals have emphasized this point. So here are Berkshire CEO Warren Buffett, ECB President Christine Lagarde, JP Morgan CEO Jamie Dimon, and they've all said the similar things. Most of the time in the crypto space, you're investing in something with no intrinsic value, and we recommend that investors stay far, far, far away from this asset class. Okay, let's move on from valuations to yield attractiveness. So we previously talked about narrowing yield differentials for US dollar, how it might lead to some USD weakness in 2023. Let's look at the same for crypto. So if you search online, you'll find cryptos claiming to offer very high yields. So I went online this morning, and I found that some cryptos claim to provide 1 million% annualized. But here's a warning. If you invest in these cryptos, I'm very sure that you'll lose all of your money. Just look at Terra USD, one of the largest stable coins previously. Promised just a 20% return on your UST deposits. And in May, what happened? It just unraveled suddenly, within a few days. From a price of $1, you're looking at about 2 cents today. Now, whether it collapsed because it was flawed, or because it was a fraud, I think as an investor, what matters to you is that any types of yields that come with these type of cryptocurrencies come with insurmountable levels of risk. And we do not recommend this for any investors looking to make money in the long run. Finally, let's look at defensiveness. So one thing we said about US dollar was that it's an inconsistent safe haven, but what about crypto? Well, the bad news is crypto is as unsafe as it gets. So this is notwithstanding the many scams we have seen in the crypto space. This is notwithstanding the contagion effect that we saw in crypto last year with collapse of companies like Three Arrows Capital. Purely looking at a simple metric like 12-month or 1-year rolling volatility, crypto is one of the riskiest asset classes available to investors by a huge margin. And we will argue that it is the exact opposite of a safe haven. In fact, if you look at Bitcoin specifically, Bitcoin has pretty much performed like a volatile tech stock in 2022. And we've seen how these have performed in a rising rates environment. But even worse, Bitcoin doesn't have any fundamentals backing it at all. So what you're essentially buying is, you're buying all this downside volatility with very little fundamentals supporting any upside at all. So let us summarize today's presentation. So for the US dollar, we think it's increasingly unattractive, again, due to a combination of 3 things: high valuations, narrowing yield advantages, as well as inconsistency as safe haven. 3 things. For crypto, it's different. We think that its valuations are absolutely ridiculous due to their negligible intrinsic value. And in fact, many of the higher yielding ones are outright scams. It is also one of the riskiest asset classes on a historical basis. And it's the exact opposite of the defensiveness you need in your portfolio with a recession coming up. So this leads to different conclusions on the USD and cryptos as a whole. So for the USD, again, we recommend you hedge your USD exposure where possible. For example, for your US equity fund holdings, consider a hedge share class. But for cryptos, it's very different. For cryptos, we recommend you to not speculate in cryptos at all. Stay very far away from it. Just don't touch it at all. And with that, I'd like to wish you all a happy, fulfilling, and prosperous investing journey in 2023. Thank you very much.
Thank you very much, Cyrus.